Thankful for being here today. Thank you for the invitation. And I'm having a great time and learning a lot. I will have to switch to English now.
About financial development and say that this talk has conceptual foundations to it, but I want to emphasize as much a presentation which is a practical guide to actually doing financial development, methods and an operational toolkit for actual implementation. And I'm along the way going to present various examples of how this is already being done in various countries and emphasize the obvious point that this can be done in yet other countries, perhaps pieces of it in Argentina as a possibility, but additional countries as well. So here's the outline of the talk. I'm going to begin with the data. So ideally we know what the facts are on the ground. And then I'm going to emphasize the use of the data through models, through theory, and give you immediately some specific examples of policy that comes from the combination of having both theory and data on the table at the same time. And then I'm going to move more broadly to evaluation of actual policy as it was implemented, as well as counterfactual policies that have been on the table and could be implemented, again, using these frameworks. So this part of the talk is like the new generation macro models that are additional tools that can be used in policymaking. And then I want to focus on some of the things that Raghu was mentioning, two active areas having to do with marketplace exchanges and financial innovation, as well as the optimal design of e-money and payment systems. And then I'll conclude. So first part of the talk is about data. I'm blessed to have had the opportunity to collect data in a project that I have in Thailand. This page you can see 6 to 8 provinces where we've been collecting the data since 1997. Actually, we started with rural areas in 1997 and continued an annual resurvey ever since. It's ongoing today. We expanded to the north and south of the country as well. Then we went from villages to now include urban areas. And we have been gathering, in addition to the annual data, very detailed monthly data. So almost 20 years of data, annual and monthly data. The map on your right, as you face the slides, is a picture of one of the 6 provinces where you can actually see the road network. Those pale dots are villages. The highlighted areas are villages that we surveyed in 1997, and then the annual resurvey, as well as the urban surveys and the monthly surveys are all denoted on the map, trying to emphasize how grounded we are in the reality of at least these surveyed provinces. By the way, you can also see the bank branches on this GIS system. Now, there's a danger in emphasizing 19, 20 years of data because it looks like who could do that again, who would want to. But I want to make the point that you can start. We did a whole lot with the initial 1997 survey alone, both policy and research papers. The annual resurveys, which is only once a year, have been done And this is not a Thai-specific enterprise. So, for example, in Mexico, Lorenzo is here somewhere, we collaborated with the government to evaluate Bansefe, and those instruments were the household survey and the institutional survey, almost exactly as we had created them for Thailand. So those instruments, quote unquote, are available. In Chile, I was fortunate to have a former student at the Universidad de Chile and also the central bank at around the same time was thinking about actually finding out what was going on in the household sector, and the central bank president, former president, is here. And so that survey, the central bank survey, has continued to 6 waves essentially, and it is a panel, at least a rotating panel. So you start small and then you continue. I understand it's quite popular in Chile and has been of great use to the central bank. And there are longer-term projects that are possible. Yale has begun surveys with the intent of surveying 5 to 10,000 households, depending on the country, over 15 years. And there's this Kavli Human project that will start in New York City with a goal of about 10,000 households starting next year, and it plans to go for 20 years. So I guess my point is you don't have to embrace 20 years at the beginning. There's a lot to be learned in the short run, and you can see how things evolve. I mentioned the Geographic Information System. This is another step. Now here it's not, quote, direct survey data, or at least in the case of Thailand, not my own data, but rather all the existing secondary data mounted on a common platform with a search algorithm. So Thailand over there has a socioeconomic survey, labor force survey, community development department, village census of manufacturers, and I could go on and on under each one of those tabs. You can enter keywords, and the algorithm searches for the variables and displays them on the map. So it facilitates fact finding. And to make the point again, this is being done with and for other countries. I put Brazil here, your next door neighbor, to try to make that point. Although we don't have as much data mounted there, I could have put China, where we have an increasing amount of data. And again, you don't have to start over. The technology exists. We have the codes. We know how to do this. We need help mounting the data and cleaning it, but the technology is available. Now, I want to talk about financial accounts. So we came, but not right away, to the realization that we needed to understand concepts of income in the context of corporate financial accounting. So one thing led to the other, and we have created for the Thai households that we survey comprehensive financial accounts, which are income statements, balance sheets, and statement of cash flow. And then I brought this quote back to the U.S. in collaboration with the Federal Reserve Bank of Boston that have been doing surveys of payments. And this has come up already and will come up even more so tomorrow. But the point is, the statement of cash flow is a way to think not only about payments devices, but also how payments and liquidity, liquidez, are related to the underlying income situation and the balance sheet situation of the small businesses and households and firms. So the left-hand side diagram here is an evaluation of virtually every major U.S. survey in terms of the comprehensiveness of coverage, PSID, Survey of Consumer Finances, Consumer Expenditure Survey, and so on. And you can see as an evaluation tool that none of them are fully integrated, although the Boston Fed now is implementing in 2016 and 2017 a more integrated version. So its dot will move over there closer to the northeast. The point again, we're done with the conceptualization of the accounts. We know how to take these accounts to existing data. We can make recommendations based on existing surveys, identify shortfalls, and that creates the possibility of supplementary surveys to fill in the gaps. Speaking of data, the landscape is changing. You're no longer limited by on-the-ground survey instruments. We have cell phone data that's available, especially for transactions. For example, companies like Mint and Plaid in the US offer household financial management services. You could do something similar for small business services. And then those data are aggregated by aggregators called like Yodlee and sold commercially. In principle, they're available for analysis. And for that matter, we have data, electronic data, coming from the financial markets, the municipal bond transactions, credit default swaps, interbank borrowing. You've probably seen papers off and on, depending, whether it's ECB, US, or Mexico, and other countries using these kinds of data. And finally, there is the possibility of collaborative agreements, in my case, of researchers with central banks to access internal bank data. I'm very fortunate to have an agreement with the government of Central Bank of Brazil and collaboration with Spain and others. So what's the goal of all this data? Map the financial system. So we don't need to speculate about what's big, what's small, what money is flowing where. The idea is to create the balance sheet, the income statement, and the statement of cash flow, or gather it from existing data, and then look how these players are interacting with one another. That is, of course, exactly the conception of the flow of funds accounts, which exist at least at an aggregated level for many countries. Flow of funds means basically if you have a company which has profits, some will go back into the business as retained earnings, but the rest of that savings goes into financial instruments, so they're investing, someone else is borrowing. And so these two pictures display, one for Thailand, over time, the relationship of the country to the traditional actors, the rest of the world, the government, households, and non-financial corporations, and you can see where the deficits and surpluses are. And the companion picture, here's a picture of a village to make the point that, we're not bound by geography when we do these accounts, if we have the data. And you can see this village interacting with the rest of the economy, and in this case by currency or loans or trade credit. And of course, you can look at things like monetary policy conducted at the national level through VARs, and then look at the impact that that is having if you have data like this, at the regional or local level. And this isn't just a pipe dream. For various reasons, the U.S. Is actively engaged in trying to create this entire map of the financial system. Britain is pretty far along this path, and I would encourage the emerging market countries to do the same. Okay, so on the modeling side, microdata, kind of obvious way I think about things, and price theory, but also contract theory, mechanism design to deal with obstacles to trade. Both of those are put into general equilibrium. So we have the preferences, endowments, and technology. I I don't invent those things out of thin air. I do it based on the measurement in the surveys. So we're modeling real economies here, villages, regions, and the whole country, incorporating those obstacles to trade, including the contracts and the required institutions. Sometimes the institutions that are dictated by the model may not exist in practice, and/or the model gives us a way to evaluate existing institutions to see whether they're, quote, good or bad in terms of achieving these desired outcomes. The bread and butter of general equilibrium theory is it allows you to look at the welfare theorems, but there is a twist here, which is not the usual emphasis that competitive equilibria are optimal and all the optima can be supported with redistribution. Rather, it's scrutiny of the existing assumptions and the reality, and finding situations where the first welfare theorem is going to fail unless there are changes in institutions. So we've actually used this to think about redesigning repo markets to correct for externalities and mitigate fire sales. So this is another approach to financial stability. And there's guidance from these models for liquidity policy, and I'll come back to that later. But again, I would like you to think of this as a new generation of macro models. We've gone through VARs and DSGE. These are micro-founded macro models. I'm going to give you some examples of how they're used for policy. You don't necessarily need to start from scratch. We have experience gained from the current set of examples. So let's talk about this theory data combination. Risk sharing. You need consumption and income data. The theory would say that idiosyncratic shocks ought to be pooled and aggregate shocks would remain, but could be allocated in the population according to risk aversion. Now, in some places there might be a presumptive policy that there is nothing out there, so guys without financial access have nothing, and you need to introduce things like rainfall insurance and indexed products. But actually, the theory and the data tell us something else, that at least in small areas like villages and kinship groups, the degree of risk sharing is already quite good. And you can actually hurt people by introducing those indexed products, because the less risk averse, the more risk tolerant businesses in the population are providing implicit insurance services for compensation already. But the general point is informal markets are already out there. It's not necessarily the case that there's nothing there, and it matters for policy. Another similar example are risk premia and financial access. So again, you look at these farmers or small businesses and you see they have very high rates of return, and you may just presume that the problem is limited credit and you need to expand the financial system to get to them. But we need to adjust for risk. The consumption data allow us to do that. And when we compute the net underlying real return, risk-adjusted return, we find the opposite that goes against the presumption. Namely, small businesses don't have the highest rate of return, at least not within their current occupation. The richer folks are actually doing better. This suggests other obstacles to transitioning into new sectors and new occupations. But the point is, you don't start with the policy. The policy conclusions come from this interaction of models with the data. And we have the codes to run these if we have the data. So you can start pretty quickly. Introducing those obstacles to trade, if you have data on investment and the capital stock in addition to consumption and income, you can actually test to see where the problems lie. Is it an information or a moral hazard problem that's constraining the lenders worrying about the borrower, or is it a commitment problem that the borrowers may run off with the capital? Both are presumed and widely used, but which one is it really? So with these models, we can actually discover things. For example, in the rural villages, it's largely an incomplete contracting problem, very limited financial instruments, whereas in the urban areas, the problem seems more like a moral hazard or a mechanism design problem, which suggests some kind of information sharing or credit registry. So then we take these micro underpinnings and we build macro models. So this one is an example of flow of funds from rural to urban areas. So when we have the villages having these savings only or very limited credit access versus moral hazard constrained insurance in the urban areas, and we calibrate the model, we discover that we can explain a big chunk of the urbanization that's happened just by those differential obstacles alone. Money will flow from rural to urban areas. In this case, the urban areas are, importing about 74% of the labor and augmenting their capital by about 30%, and both labor and capital are leaving the rural areas. Now, we're not claiming this is the only source of urbanization. There's all kinds of externalities and infrastructure associated with urbanization, but we think that it makes the point here that populating the models with these observed micro underpinnings actually helps you to understand how the flow of funds within the financial system. And then if you take that to the next step, you can look at both repressive and expansionary policies. So, for example, here, with a somewhat integrated Thai financial system, we did the counterfactual of shutting down trade or shutting down capital flows, and at the estimated parameters, we can back out the welfare gains and losses from that kind of intervention. And you can see here they're quite heterogeneous. So, for example, shutting down capital outflows makes there be more capital at home, which lowers the interest rate. That has a negative effect for medium to wealthier households who had been saving at interest. It has a positive effect on businesses that are capital intensive because now that capital is cheaper. There's a differential impact based on the TFP or underlying productivity because these guys can also shift occupations, not just doomed to be a wage earner, but potentially becoming a small entrepreneur. And here, at the national level, you can back out what actually happened in the past. Thailand expanded. It allowed those capital inflows, and I can talk about the financial crisis later. Those capital inflows were one aspect of the expanding financial system, but the other thing the government was doing was putting branches of banks or allowing commercial banks and government banks to expand throughout the country. And so you can see here, if you look closely, what would have happened if there were no reforms. What's the effect on growth and inequality due to allowing capital inflows but not expanding the domestic banking system, vice versa, shutting down capital inflows and expanding domestic banks. They're all here on the same table and same graphs. So you get a quantitative evaluation ex post of what happens. And I have two examples that I'll skip over a bit. Just to make the point that it's not just generic. You can fine-tune these models to deal with the expansion path of a government development bank and how it's playing sort of a strategic equilibrium with the commercial banks in a way that seems neither to promote financial access nor generate optimum social welfare, suggesting a potential change in policy. And we have these village banks that came in when the government put a savings and loan in every village in the country. And here we can evaluate who gained and who lost. People who were sort of hand to mouth benefit a lot from the increase in credit. There is also an investment possibility. They may co-fund that investment, so potentially investment will jump up. But typically we ignore this kind of heterogeneity when we're thinking about policy, but it's really quite real. And here's the data through the lens of the model. Exactly what role the village funds played is not so clear, and it's still politically contentious. Some people believe there's a lot of corruption in the allocation of money from the village committee, although other work shows that the people who did get the money and previously had high return on assets actually are investing. And it does seem that that informal sector that I alluded to earlier is playing a very active role here. So it's not as simple as just replacing the informal sector. It looks like the informal sector was there playing a role, but somehow its role was enhanced when this quasi-formal village institution program was introduced. We're still working on that. So the two topics, hot topics really, have to do with new technology. One, these marketplace exchanges. As Raghu was saying, China may be a case where the innovations have been huge, but it's a bit like the Wild West, and there have been some unfortunate episodes. But again, starting with a repressive financial system working through state-owned banks, the private sector emerged to, flourish in some good and maybe some unfortunate ways. So how do we think about that, and is that a direction for countries to go? And I'll just say this is not simply only an emerging markets issue, it's also an issue in the U.S., with respect to over-the-counter markets, and should they be regulated, should they be migrated to central counterparty platforms, some arguing that there ought to be only one platform and it ought to be a regulated utility, and other people finding decentralized financial markets work just fine. And certainly in Thailand, I find myself in the situation of going back to first principles. Again, the irony of Thailand is, ever since the financial crisis in '97, the Thai financial Asia crisis, they've been a very conservative regulator. They really don't want any innovation. It's all bank-based. But that has left the results you've seen on the earlier slides. So in some respects, it's a huge opportunity now for Thailand to expand. And likewise, Argentina, for example, now with the new government and, all this possibility for new policies and new reforms. So it may be an opportunity here to start with something that might not have been there if it had been left to be happening only incrementally. So let me just say, in broad outline form, there are forces for these financial platforms to be centralized, and indeed there might be room to have only one of them. Depends on your view of financial intermediation, having one large player and fixed costs, as in some work of Doug Diamond. There also seems to be some good centralization or regulation associated with the creation of credit registries, or having observed trades in central counterparties. But there is also room potentially to have multiple financial platforms depending on trade-offs between increasing marginal costs of interaction and the benefits of further diversification. And you can have these kind of hybrid systems where you have joint liability groups operating locally, monitoring each other, or dealing with impediments to trade, and then that's sort of a vehicle to piggyback in terms of access to the larger financial system. And likewise, I do the same thing with analysis of payments, looking at the rise of M-Pesa in Kenya and e-credit, and but there are questions about how well e-credit really works and whether you can piggyback on top of that in terms of building a better financial system. And there are issues in the U.S. about payments. This is not exclusively just a developing country phenomenon. Is the financial plumbing ready for 24/7 fast payment systems? And likewise, when you think about first principles, there are potential problems associated with liquidity, namely information systems, as in distributed ledgers. Decentralizing it and allow the private sector to do it can create benefits, but some problems in intraday credit, some problems in coordination of private debt, which is circulating as high-velocity means of exchange. So again, the procedure here is to take each one of these topics, which I've had to rush a bit to get through, and just think from the standpoint of first principles, what would we expect to see that provides some overall guidance for where you want to go as policymakers, and also what problems may emerge in this process to get ahead of them as they might happen. So data, yes, go ahead, start getting it, figure out where the gaps are, evaluate it, create this GIS platform, use these theories and models to do the next generation evaluation, use the theory-data combination to evaluate policies and create evaluation of actual and counterfactual policies, and use theory and what we know from the data to think about marketplace exchanges and liquidity policy. Thank you.
Entonces tenemos unos 5.
We have 5 minutes for questions and answers.
Le acercamos el.
We will hand out the mic. Questions for this first panel?
Just a quick question for
Buena pregunta para ambos oradores.
financial education on all of this, please.
Look, again, I think it's very important, and it's very important, especially as you're including more new people into the system. And it's important not just for those new quote-unquote unsophisticated people, but existing sophisticated people. And let me tell you one thing that always kept me awake at night in India. It was cybersecurity. And cybersecurity is not just about systems. It's about culture. And it's about culture in every bank, every employee of the central bank, every employee elsewhere. So as the system sort of expands, gets more sophisticated, gets more technologically oriented, I think there's an education process, right from the most unsophisticated person to the most sophisticated person. I mean, if you recollect the stuff on the Bangladesh bank that is widely available, is that the password was taped on the screen of the computer that was used to access SWIFT. But they are not unique in that so many places have passwords 1, 2, 3, 4, 5, 6, 7, 8 if they get more sophisticated. And so that's one example, but just the repeating the old adage, there's no quick way to make money, that there's a sucker born every minute, and that often that's a way of cooling down passions when people see these wonderful opportunities being thrown before them. As much as technology helps us access, it also helps the thief access everybody. So, I mean, so many areas of, I've just touched on a couple of this thing, but I think it's critical, and we have to work very hard on it across the board.
Well, I guess is this on?
Yeah.
I would second that. What I often see people making the mistake of assuming if you could sit small businesses or farmers down in a room and lecture them for 2 hours about rates of return and compound interest, that they'll somehow get enlightened and change their behavior. I think it's a much more complicated process than that, and one thing we're experimenting with is taking their own data back to them and sort of placing them in the context of their own situation. They have to be motivated by something they really care about in order to be willing to sit down and learn and potentially change behavior.
Federico.
Yes, I have a question for each of the panelists. For Raghu, one of the things that we're concerned going forward is the situation of the financial sector as inflation comes down. I think this is something that Arminio also touched today. Banks profit from the inflation tax because they take sight deposits and pay zero, and then they lend at a relatively high nominal interest rate if inflation is high, and they pay their fixed cost out of that. So as the inflation rate comes down and nominal rates come down, it's going to pose a challenge. So any thought, if you went through that experience or through that problem in India or not, and any reflection you may have on that. And for Robert, a very specific question that we have on something that you also touched briefly, but it's very important for us. We have all this discussion about centralized counterparty in derivative markets, but we have a very undeveloped derivatives market. So, for example, one idea we're thinking is that imposing on the OTC transactions over the counter the same kind of restrictions as if you would have a centralized counterparty, for example, the mark-to-market requirements. But in the last meeting of the BIS, we were discussing among some of the governors that maybe that imposes too heavy a burden on the OTC markets. We can understand that from the perspective of developed economy, but in the case of an emerging economy, that may actually make it more difficult for those derivative markets to develop, and we really need them, for example, in the foreign exchange derivatives market. So if you have any thought that we should move in that direction or we shouldn't?
So, quick response. I think that is an issue. For us, of course, we started with lower rates of inflation, so it's probably going to be a bigger issue for you. The big concern for us was, of course, that they have negative real rates on their deposits, positive real rates on their loans, and as both turn into positive territory, their margins shrink, and they have to deal with that. I think they will figure out. My worry more is going to the first question about financial literacy. There are a whole number of depositors who don't understand what a real rate is, unfortunately. And they don't see that they are actually better off with lower nominal rates but higher real rates, because they see nominal incomes in their hand and they say this has shrunk, while not recognizing that the effect of inflation was on their principal and reducing the real principal that they got back significantly, and so they're not quite able to see that. As a result, banks are reluctant to also reduce deposit rates somewhat, because they say, well, we will lose a lot of depositors in this process because they will turn to real assets, not recognizing that real rates. So there's a process of education also in this process of disinflation, when you come from a period in which people have had very high nominal rates with high rates of inflation down to low nominal to low inflation.
So my answer is it's not as just the extremes of it's over the counter versus it's some CCP, The point is to identify the contracts, explicit or implicit, that the parties have, traders say have with borrowers and lenders, buyers and sellers, and so on, and also keep track of the information structure and make some decisions about how centralized, what kind of reporting you want and how centralized it ought to be. I mean, the U.S. certainly didn't put every derivatives market into a CCP, although I'm not sure in practice that I necessarily would agree with what they put where. But the point is you have trade reporting requirements, trace, that's applicable to any transactions, not just ones being done under CCP. So use the fundamentals I was alluding to make some decisions about what an optimal design would be. And you do see those over-the-counter markets in villages where they don't even think of them that way, let alone among merchants who are engaged in credit chains and the accounts receivables and payables that work their way through the chain. I think the fact that you see that emerging in so many different contexts is indicative of the potential economic benefit. But I'm not arguing that OTC means unregulated.
Lorenzo, una última pregunta.
Lorenzo, one last question.
Regarding this balance between regulation and innovation, in particular regarding this new policy of sandboxes. In some ways, it sounds like very innovative and say, well, just see what happens, and then if it works, then we incorporate those to the financial sector. But in some way, the risks are the same as always, like we know which are the financial risks. Probably there's something that we don't know in terms of technology and how that will work. But in some way, it's also very difficult to see what are the rules of the sandbox, because obviously it needs rules because there are going to be a lot of players that want just to arbitrage regulation. So one alternative might be just to be more flexible or faster to have new regulation, because sometimes the problem is that the current regulation don't incorporate new technologies, and that might be a barrier to innovation. So would that be an option, or how to determine these rules for sandbox in such a way that it's not just an arbitrage for regulation, or something that might be even more difficult to deal afterwards?
I mean, I sort of, in Arminio's vein of saying it simply, the tradition for regulators is what you don't understand, don't allow, right? And I think the sandbox, it is what you don't understand, watch and wait. What you do understand, of course, you regulate. What you don't understand, see how it plays out, and then see what you need to do. So it's a little bit of what the default option is. Default option is not to ban it, but to let it sort of work itself a little bit to see how it goes. The danger of taking a regulatory action there is you may snuff out the innovation too early without seeing what is possible. And one of the things is the pace of innovation, especially in fintechs, is such that they may take care of some of your concerns, because the concerns will get expressed through the marketplace. And so they may take care of it through other means than, hard regulation. So I think the philosophy is, when it's small, it's not systemic. Yes, people will lose, but it's not, don't worry too much. And if it starts getting big, then something is working. Now see what your concerns might be.
But you need data to know it's big, right?
Oh, no. So absolutely. The point about sandbox is not to leave it unsupervised. You need the mother or the father on the edge of the sandpit to see the kids and to make sure they're not fighting.
Okay, so thank you very much for two very interesting talks. And we break for coffee, and we'll be back for the last session.